Ather Energy has undergone a dramatic transformation in FY25. And if there is one product that's at the heart of this shift, it's Rizta. Rizta is not just a new scooter, it has fundamentally changed how Ather operates, how it sells, where it expands, and what margin it earns. Since its launch, Rizta has become Ather's best selling scooter, and it has overtaken the long standing 450 series in just a matter of few months. More importantly, it has helped Ather reposition itself from a premium only brand to one with mass market appeal without sacrificing financial performance. Let's understand how Rizta has impacted Ather's business across multiple dimensions: sales, revenue, margins, brand perception, retail strategy, and long term growth potential. The 450 series has been Ather's flagship for nearly 6 years. It was designed for performance, innovation, and premium positioning, but it came at a price point that limited its appeal beyond a certain niche audience. Rizta changed that. Despite being new to the market, Rizta quickly overtook the 450 series in terms of unit sales. It's now the majority contributor to Ather's total volumes. Since its launch, Ather has sold over 1 lakh Rizta units, and that's an average of around 10,000 units per month. The Rizta lineup consists of 3 variants. Deliveries of the base variant Rizta Z began in May 2024, the higher battery variant in July, and the third most affordable version in August. This staggered launch helped Ather test the waters and gradually scale up the volumes across different pricing tiers. The results were immediate. Prior to Rizta, Ather's monthly sales volume typically ranged between 4,000 to 9,000 scooters. For instance, April 2024, the number of units sold was 4,143 units. In May 2024, it was 6,153 units. In June 2024, the sales were 6,216 units. But from July 2024, when Rizta's higher variant started shipping, sales crossed the 10,000 mark, and Ather has been consistently selling more than 10,000 units since then. Notable peaks include October 2024, when they crossed the 15,000 units mark, and in March too, they were able to sell more than 15,000 units. So this is a clear before and after moment for the company. With Rizta, Ather entered a new league. In FY25, Rizta contributed over 50% of Ather's total volumes. Compared to FY24, Ather's total scooter sales grew by 42%, and that growth was almost entirely driven by Rizta. Let's look at the quarterly volumes. In quarter 1 of FY25, pre-Rizta, Ather sold 23,000 scooters. In quarter 4 of the same fiscal, they sold 47,411 units. That's more than 2x growth within a single financial year. These are not incremental improvements, these are transformative shifts. Rizta also helped Ather increase its market share significantly both in the south and in the newer regions. In the south, market share rose from 13% in quarter 1 to 22% in quarter 4 of FY25. At the national level, Ather's share in the EV two-wheeler market grew from 7.4% to 13.3% by quarter 4 of FY25. But the biggest jump was seen in non-south markets. In Gujarat, for example, where Ather had a minimal presence earlier, market share jumped from just 4% to 25%. Clearly, Rizta is not just a product that sells, it's a product that expands the company's reach across the country. All this volume growth translated into strong revenue gains. In FY25, Ather's total revenue grew by 30% year on year. Quarter 4 of FY25 revenue was 687 crores, up 28% compared to quarter 4 of FY24. Importantly, this was the first quarter where Ather outperformed Ola Electric on revenue. Ola reported 651 crores in quarter 4 of FY25. Beating Ola Electric in revenue is a milestone that Ather hadn't crossed before. Rizta made it possible, helped of course by the sales slump that Ola is going through in recent months. If you have been with me so far, you may be interested in our flagship course on one of the sunrise sectors. which is semiconductors. When some of us hear the word semiconductors, we think too technical, not for me. But smart investors know this. Semiconductors are the new oil. From smartphones to AI, EVs to defense, cloud computing to modern healthcare, chips power everything today. Global investors who spotted this early made serious wealth from companies like Nvidia, TSMC, MediaTek, Qualcomm, SK Hynix, Samsung, and Applied Materials. These are big names now and have turned into multi-baggers over the last decade or so. Now here is the exciting part. India is entering this game right now. Government has a massive outlay of 10 billion US dollars for Semicon India program. That's easily the highest incentive announced for any sector here in India. Big players like the Tatas, Adanis, Vedanta, HCL and some smaller ones too like CG Power, Keynes, Dixon are all eyeing this opportunity. They are setting up chip manufacturing, packaging and design hubs. So we spent nearly 2 months researching and breaking down this complex industry and then built this course that explains it all simply and clearly from an investor's angle. You learn how the chip manufacturing, packaging and design industry works, where India fits in, which Indian and global stocks are worth tracking, and how to avoid the hype, manage the risks, and spot the real opportunity in this sector. Check the link to our course on semiconductors in the description or in the pinned comment below. Thank you. Here is a surprising bit. Rizta is priced lower than the 450 series, but instead of compressing the margins, it actually improved them. How is that? Cost of goods sold, the COGS fell from 1,48,000 to 1,20,000 per unit. That's a 19% reduction in per unit cost. Rista's bill of materials is 7% lower than the 450 series. This cost advantage combined with high volumes helped Ather reduce overall production costs. The result was that adjusted gross margin improved from 9% in FY24 to 19% in FY25. Gross margin without subsidy rose from -6% in FY24 to plus 12% in FY25. Prior to Rizta, Ather was trending at -35% to -36% in EBITDA margin. Post Rizta, their EBITDA improved to -22% to -23%. This demonstrates that volume expansion significantly reduced losses per unit for Ather. Tarun Mehta, CEO of Ather, says he expects volume growth brought in by Rizta to continue for next 12 months to 18 months before it stabilizes. This sales momentum has given Mehta the confidence to say, I think FY26 and FY27 will be quite transformational for our overall P&L. In short, rather than dragging down profitability due to its lower price, Rizta has lifted it. Margins didn't just improve because of cost efficiencies. Software played a big role too. Rizta buyers, despite being more price conscious, are still opting for the Ather Stack, the company's software package. The Ather Stack software package is sold as an add-on outside the base purchase price of the scooter. It is optional and can be subscribed to either at the time of purchase or post-purchase through the Ather app or dealership. While I haven't checked the recent price, Ather Stack sells for about 13,000 for 3 years if you buy the subscription when purchasing the vehicle. I believe the price can double if you subscribe to it post-purchase. So what exactly is Ather Stack? Ather Stack refers to Ather's connected vehicle software suite. It includes features such as navigation on the dashboard, over-the-air updates, ride statistics and analytics, remote diagnostics, theft and tow alerts, charging station locator, and mobile app integration including WhatsApp. As I said earlier, though Rizta was positioned in the mass market segment, majority of its buyers still opted to pay for the Pro software pack, just like those purchasing the premium 450 scooters. In fact, in FY25, with increasing share of Rizta purchases, Ather Stack adoption rose from 84% to 88%, which was described as a positive surprise by the Ather management. Ather Stack now contributes 6% of the total revenue for the company. Remember, since software has minimal incremental cost, this revenue stream comes with very high margins. Whether 5,000 users or 50,000 users opt for it, the cost doesn't change, but the margin scales. Ather Stack has given Ather a powerful lever to stabilize average revenue per user even with a lower price product. Normally, we would expect that the average revenue per unit to drop by a significant extent when a lower price scooter becomes the bestseller, just like it did for Ola. But that hasn't happened for Ather. Despite Rista's 1.09 lakh entry price versus 1.3 lakhs for the 450, Ather's average revenue per unit has remained close to 1.3 lakhs. That's largely due to stack upgrades, higher pricing in non-south regions, lower discounting and improved sales mix. This means Ather has expanded its user base without diluting its revenue profile. With Rista's success, Ather finally has the confidence to scale up its store network, especially outside South India. Previously, opening stores in the non-south regions wasn't always viable for Ather. The premium 450 series didn't guarantee sufficient footfall or sales. But Rista changed that. Ather now has total number of 351 experience centers. In FY25, new centers added were 143. So that's 40% of the total network added in just 1 year. And most of these new centers are in the non-south regions. Here is how the store openings ramped up. In Q1 of FY25, 10 new stores were opened. In Q2 FY25, 13 new stores came up. In Q3 FY25, we had 34 stores being opened, and in Q4 of FY25, 86 new stores of Ather were opened. In fact, 69% of the FY25 store additions happened in just the last quarter. This kind of aggressive expansion suggests that the company now sees a viable pathway to profitability in the new regions. Rista helped Ather unlock a critical segment, the family-oriented buyers. In India, 82% of the scooters sold are in the family segment, not the performance segment. The 450 series was positioned for performance. It appealed to enthusiasts and early adopters, but a good chunk of family buyers were perhaps left out. Rista fills that gap. With its comfortable ride, practical design and lower price point, Rista has helped Ather attract new demographics. Middle-class families, first-time EV buyers and price-sensitive urban commuters now see Ather as an option. And while Ather management doesn't expect Rista to occupy as high as 82% share of its sales, being a family scooter, it has already become the majority contributor to its own volumes. Ather recently went public with its IPO towards the end of April this year. And if you look at the company's growth pattern, it's clear that Rista's success played a big role in IPO readiness. Now, instead of being a single product company, Ather now has a tiered scooter lineup with both premium and mass market offerings. This strategic breadth made the business more stable and investable. Eventually, Rista helped Ather achieve several big wins like crossing 680 plus crores revenue in a quarter, beating key competitor Ola in top line, expanding to new geographies, improving margins and unit economics, and it built a diversified product portfolio for Ather. Hence, the launch of Rista has redefined Ather's growth path. What began as a single scooter to target the family scooter segment and address pricing gaps has turned into a growth engine. To summarize, Rista did many positive things for the company. A massive sales boost, a sharp jump in market share, national expansion, lower costs and better margins, software upsell revenue, improved brand reach in family and mass segments, and a more compelling financial story ahead of the IPO. More importantly, Rista helped Ather expand without losing its identity. It didn't sacrifice margins or product experience. It simply scaled up what worked and brought more people into the fold. In doing so, Rista became much more than a scooter. It became a turning point in Ather's journey. And going by the numbers, this is perhaps just the beginning of a long journey. Thanks for watching. Have a great day.